Good day everyone and welcome to Moementum channel. Today we're going to talk about three biggest e-commerce companies that are traded in the stock market: Alibaba, Amazon, and Shopify. We'll review these companies and compare them in terms of their revenue, book value, valuation, year-over-year growth, and of course looking at their latest earnings report. And at the end of the video, I would also share with you my opinion in terms of which one is a better buy at this time. But before we dive into this video, I want to put things into perspective and compare the size of this company. The smallest company here in this group is Shopify, which has roughly about $80 billion in market capitalization. Next, we have Alibaba with roughly $523 billion in market cap. And lastly, the largest of these three companies is Amazon with close to $1.1 trillion in market cap. The first metric that we want to look into to compare these companies is price to earnings. The price to earnings ratio, also known as PE ratio, is the measure of the share price relative to the annual net income earned by the firm per share. The PE ratio shows the current investor demand for a company. Now, of course, the PE ratio could really fluctuate depending on the industry that the company is in. But as for these three companies, they are more or less in the same industry. So it can give you a good idea in terms of the company's valuation compared to its historical values. As for Alibaba, its current PE ratio is at 20.78. This indicates that it's being traded at about 21 times its earnings. As for Amazon, this PE ratio is much higher at close to 110 at this time. Shopify, however, does not have any PE ratio, and this is because Shopify is a loss-making company at this time, and it doesn't have any net profit as we speak. Now, what's quite interesting is that if you look at the 5-year average for PE ratios, Alibaba's 5-year PE sits at close to 40. So at this time, it is in fact a lot less than its average 5-year PE ratio. And when you compare it to the previous years, in fact, it's at its lowest since 2015 that we have here on this slide. As for Amazon, though, it's in fact one of the highest ones, at least compared to 2018 and 2019. However, the 5-year average PE ratio for Amazon has been also historically very high and sitting at close to 225. So looking at this metric, and if we were to base our judgment on the valuation, Alibaba is a cheaper company compared to its historical PE ratio for sure. Next, we have price to cash flow. The price to cash flow ratio is a ratio used to compare a company's market value to its cash flow. It is calculated by dividing the company's market capitalization by the company's operating cash flow in the most recent fiscal year, or equivalently by dividing the per share stock price by the per share operating cash flow. So if you look at Alibaba, the price to cash flow is currently sitting at 18, roughly about 18, whereas for Amazon, it's almost double that amount and it's sitting at 30. For Shopify, it is way higher, and in fact, it sits close to 1,000. So the price to cash flow is really, really high. Obviously here, again, the lower this number, typically it suggests the better it is, as long as the company has solid fundamentals. So again, looking at these numbers and this metric and comparing it again to the 5-year average, you could see for Alibaba, the current price to cash flow is lower than the 5-year average, and in fact lowest compared to any of the past 5 years, whereas for Amazon, it sits very close to its 5-year average. So again, a little bit more positive for Alibaba in terms of this metric. Next metric that we will look at is price to book value. This is a metric that allows you to compare a firm's market capitalization to its book value. And it is calculated by dividing the company's stock price per share by the book value per share. For those of you who may not be familiar, book value is the net assets of a company and is calculated by taking into account the total assets the company owns and deducting from it any intangible assets such as your company's patents or goodwill, as well as deducting any liabilities. So if the price to book value is a smaller amount, that just shows that you're getting a better deal for the most part. As for Alibaba, this sits at 4.87, Amazon is much higher at 17.70, and Shopify is sitting at 25.61. Here I'm leaning more towards Alibaba because of it's a better price to book ratio. Next metric that we're going to look at is price to forward earnings. which uses the forecasted earnings for the PE calculation. Because forward PE uses an estimated earnings per share, it may produce incorrect or biased results if the actual earnings of the company prove to be different. Analysts often combine the forward PE and the trailing PE or the current PE to make a better judgment. Here, for this metric, price to forward earnings, Alibaba currently sits at 23.20, Amazon sits at 74.63, and for Shopify, it's a whopping 10,000. As for this metric, usually again a lower number suggests that it could be a better buy for you, but to be safe, you could always compare it to the 5-year average for that company to see where it sits. Alibaba, on a 5-year average, typically the price to forward earnings sits at 27, as for Amazon sits at 85, and for Shopify close to 1,000. So Amazon and Alibaba seem to be better aligned with their 5-year average, and as for Alibaba, definitely it's lower than Amazon. So again, I'm leaning towards Alibaba even on this metric. Stock price return. This metric looks at how the stock price has performed over the past calendar years. In 2015, Alibaba actually had a negative 20, almost 22% performance, whereas Amazon had a whopping 117% return. You can see over the years how this has changed. Amazon and Shopify have done quite well this year. You could see that 25 and 65% respectively for these two companies, whereas Alibaba has actually gone down by close to 10%. This has a lot to do with the recent pandemic that we've had, and the fact that it originated in China and has of course impacted their business. But if history is any indication of how a company would perform in the future, you could anticipate that Alibaba, once it gets its groove back, it's going to have a huge growth potential ahead of it. As for gross margin, which equates to net sales minus the cost of goods sold, you could see that Alibaba has a trailing 12 months percentage of 45, Amazon has 26% gross margin, and Shopify has roughly 54% gross margin. The higher this metric, usually the better. For the sake of reference, we've also provided the 5-year average gross margin percent for these companies. As for Amazon, they're doing a little bit better than their 5-year average, whereas as for Alibaba, it's lower than that. And Shopify is, for the most part, in line with its 5-year average gross margin percent. This percentage is a proportion of gross margin to the total revenue of the company. Next metric we want to look at is the return on assets. Alibaba is showing a trailing 12 months of 15.37%, Amazon 5.29%, and as for Shopify, we have a 4.35% negative for return on assets. The return on assets shows the percentage of how profitable a company's assets are in generating revenues. The ROA tells you what the company can do with what it has. In other words, how many dollars of earnings they can derive from each dollar of assets that they control. Return on equity percentage is the next metric that we'll look at, which is a measure of financial performance calculated by dividing the net income by shareholders' equity. Because shareholders' equity is equal to a company's assets minus its debt, the ROE is considered the return on net asset, and it measures how many dollars of profit are generated for each dollar of shareholders' equity. As for Alibaba, this percentage is close to 29, Amazon sits at 19%, and for Shopify, it's a negative 4.89%. So Alibaba is doing better on this metric, followed by Amazon. Now, in the next sets of charts, we want to continue this comparison of these three companies. The first one is looking at the total current assets. Amazon, obviously, because it's a larger company, they have higher assets, and they're currently sitting at $96.33 billion in assets. Alibaba, 66 billion, and Shopify, which is the smallest company of the bunch, has 2.75 billion in current assets. Cash flow from operating activities, and looking at it quarterly, in the last quarter 4 of 2019, Amazon was the highest in this group with highest cash flow from operating activities of 38.51 billion, followed by Alibaba and Shopify. Next, we have current ratio, which is a liquidity ratio that measures whether a firm has enough resources to meet its short-term obligations. It compares the firm's current assets to its current liabilities and expressed as follows. The current ratio is an indication of a firm's liquidity. So here, Shopify is doing way better, suggesting that they have a lot more liquidity in terms of cash and cash equivalents to service their debts. This is followed by Alibaba and Amazon. The next graph that we'll look at is cash on hand. Here, Amazon and Alibaba are sitting very closely at close to $55 billion in cash. Shopify is the smallest of the bunch. As for revenue, this graph kind of correlates with the size of these companies. Amazon has the highest revenue of this group with $280 billion in revenue. Alibaba sitting at $71 billion and Shopify with $1.5 billion in revenue. The next graph shows you the earning per share and how it has changed over time for these three companies. What's quite interesting is the growth rate for Alibaba. As you can see, there was a huge spike from Q2 all the way to Q4 of 2019, whereas for Amazon, it seemed to have slowed down a little bit. We've also taken a look at the earnings reports for these three companies for a number of measures. So first, we'll take a look at Amazon's. In the presentation slides for the latest quarterly reports for Amazon, we noticed that their net income has actually declined and it was reported to be $2.5 billion. Of note was also that they were emphasizing that in terms of their long-term goal, they want to optimize their free cash flow. This aligns with some of the metrics that we looked at before, particularly the cash flow from operating activities, where although Amazon had the highest cash flow compared to the group, still it needed to improve on that metric. Looking at Shopify's earnings report, what really stands out for me is their revenues, that definitely is growing over time, but of course they have also high operating costs, which causes them to actually be a loss-making company over time. And lastly, looking at the earnings report presentation from Alibaba, the latest one that they are showing how they are doing in terms of their revenue growth, focus on the cloud computing sector, in terms of their consumers and profitability and cash flow. What really stands out for me is their revenue growth, that they're showing a 38% growth year over year. They are also putting a lot more emphasis in their cloud computing, which is really noticeable. This Amazon also has Amazon Web Services and the cloud focus. As for Alibaba, they are showing a 62% year over year revenue growth for the cloud area and domain. Lastly, as for their consumers, they are showing that they have roughly about 824 million mobile users and 711 annual active consumers. These figures are for the 3 months ending December 31st, 2019. The review of three different giants in e-commerce and how they stack up against each other in terms of valuation and a number of different metrics. As I promised earlier in the video, I'm going to share my pick among these three companies if I were to invest in them. Honestly, I think each and every one of these companies is a fantastic buy in terms of long-term view. But if I were to only pick one, I'm leaning towards Alibaba. This is mainly due to the better valuation that they have at this time, and also keeping in mind their huge growth potential over the next several years. So that's going to be my pick among these three companies. I hope you enjoyed this video. I would love to hear from you in the comment section down below. Let me know which one of these companies is your pick, and would you consider buying any of them for your portfolio? Would love to hear from you. If you did enjoy this video, please make sure to hit the like button and subscribe to our channel. Here on Moementum channel, we post weekly videos about investing, finances, and personal development. Hope to see you next time.